In our last lecture, we were looking at ways that changes in exchange rates can impact profitability, choices of where to produce, all these things that businesses have to decide. And we started by looking at transactions exposure. So today what we have to do is look at something slightly different, another type of exposure called economic exposure. So economic exposure is defined as the degree to which a firm's present value of its future cash flows can be influenced by exchange rate changes. What does that mean? Well, how does the bottom line going to change if exchange rates change? How is it going to change where you buy and sell from? For example, if you're an American company and you sell your input in both the United States and Canada, but you also buy inputs from Canada, would changes in the exchange rate affect your bottom line? Well, of course, there's going to be some effect. If the dollar depreciates, which means the dollar buys less foreign currency, that will then mean it takes more dollars to buy the Canadian dollar. So how is that going to impact your bottom line? Well, from the Canadians' perspective, your goods are going to look cheaper. So revenue from Canada should increase. There should be more demand for your goods. So on one side, that's really good. But on the other side is, as the value of the dollar depreciates, the value of your Canadian inputs are going to become more expensive. So while revenue goes up from revenue from Canada goes up, your costs are going to go up. Now, which go up by more would have to be something we would look at. So how do you deal with such economic exposure? And that's where something we call restructuring would come in. Now, restructuring is simply defined as changing where you buy and sell in order to change your bottom line. So for our example, a previous example, it's great to keep selling in Canada when the value of the dollar depreciates against U.S. dollar depreciates against the Canadian dollar. But what about the increase in costs? So to restructure, keep selling in Canada, but you know what? Let's see if we can find a U.S. supplier of that input so that you can decrease your costs of production. All right. When you're thinking about restructuring, there are some things you need to take into account. Should you try to increase or decrease your sale in your existing market, or should you look for a new market? Again, what's going to help your bottom line? Should firms increase or decrease your dependency on foreign suppliers, right? In our previous example, we wanted to decrease our foreign suppliers. Should a firm establish or produce in foreign markets? If the value of the dollar appreciated, became stronger, then foreigners would stop buying U.S. goods. In that case, doesn't make sense to set up a subsidiary or somehow enter into a foreign market producing in a foreign market. And finally, should a firm change what currency it does business in? Is it possible to have, instead of getting paid in US dollars, could you get paid in Canadian dollars and then hold those Canadian dollars to exchange at another time? Who knows? But these are questions you should think about when you're contemplating restructuring. The next issue that we need to look at when we think about economic exposure is how much exposure are you likely to have? And to measure economic exposure, what you're going to look at is what is the sensitivity of earnings to your exchange rate. Look and see how changes in exchange rate will affect your revenue and your costs. All right. Are you buying very little overseas, but you're selling a whole lot more? Things like that. And also see how sensitive your cash flow is to your exchange rates. So can you see now how changes in exchange rates, this move to this flexible exchange rate system, has really caused a lot more issues for businesses than being under the fixed exchange rate? All right, so right now we've gotten to the midpoint of the semester, so you should be getting ready to take your final exams. And I will see you next week, in which we start working on the last half of the class. Take care. Bye-bye.